Novo Nordisk, ticker NVO.
Yeah, and this is a company that has basically become the poster child for the huge growth in the obesity care market.
Exactly, but that's what makes the core conflict here so massive.
It really is. I mean, the company's fundamentals look so strong, yet the stock is sitting at $57.34 right now.
And that's way, way down from its 52-week high of, what, $93?
Almost $94, yeah. The market has just punished this stock over the last year.
And that's our mission today. We're going to dig into this report, which argues that this huge sell-off, this valuation compression, isn't a sign of weakness at all.
No, it's actually a profound opportunity. The analysis calls it a generational reset in the stock's value.
And it's happening right before what could be the next major catalyst for the company.
That's it. So the report isn't just saying, hey, NVO is a good company. It's giving 3 very specific converging reasons why, right now, at this price, could be a rare window to get in.
So we're going to break down those 3 pillars for you.
Yep. First, the valuation, which they say is just absurd. Second, the technical signals that the selling has finally stopped.
Yep.
And third, the big one, the earnings catalyst, coming up on February 4, 2026.
All right, let's jump right into that first piece, the valuation. This first segment is all about one surprising number at the heart of the whole thesis. The report points out that NVO's current PE ratio is just 15.73.
Yeah.
To me, that's incredibly low for a growth stock, right?
What's fascinating here is the context. You have to remember where the stock was just a year ago.
Right.
For years, NVO traded at this massive premium, somewhere between 30 and even 40 times earnings.
And that was all based on the hype around drugs like Ozempic and Wegovy.
Exactly.
Yeah.
The GLP-1 drug class.
Yeah.
The market believed in this multi-trillion-dollar long-term story.
So the stock was just running on pure adrenaline, on future hopes, and now that premium has been completely stripped away.
It's aggressively stripped away.
But what made the market slam the brakes that hard? I mean, to go from a PE of 40 down to 15, there has to be some real risk there, doesn't there?
That's the key question, and the report tackles it head on. The argument is that the compression wasn't because the products failed. It was market panic over 2 sort of short-term issues.
Okay, what were they?
First, the supply constraints everyone was talking about. They just couldn't make the drugs fast enough to meet demand. And second, the competition, specifically from Eli Lilly, started looking like a much bigger threat.
So the market saw those 2 things and basically priced the stock for complete stagnation.
Precisely. Investors looked at what were probably temporary supply chain issues and one strong competitor and just decided to value the world leader in a future multi-trillion-dollar market like its best days were over. And the comparison the report uses is, I think, really powerful. It says you're getting this dominant, high-margin pharma giant for what is essentially a utility stock valuation.
A utility stock, like a power company or something.
Exactly. Companies that are known for slow, predictable, regulated growth. They often trade in that 14 to 16 PE range.
But NVO is a scientific innovator with, huge growth potential.
That's the contradiction. The market has priced it like its growth story is finished.
So they're getting all that potential for the price of a boring, stable income stock. And while you're waiting for the market to figure that out, the report says there's a kind of a safety net built in.
Absolutely, the dividend.
Right.
While you wait for the market to re-rate that PE multiple back up towards its historical average, you're collecting a dividend yield of around 3.01%.
So you're literally getting paid to be patient.
That's the idea. It minimizes some of that downside risk while you wait for the story to play out.
Okay, so the fundamentals look almost absurdly cheap. But that still leaves the question, why did it fall so hard? And how do we know it's not going to just keep falling?
And that brings us right to our second pillar, the technical reversal.
Right.
Yeah, because the technicals are so important here. For a while, this stock was what traders call a falling knife.
Yeah.
And you never want to try and catch a falling knife.
Here's where it gets really interesting. We saw how brutal that sell-off was. I mean, it bottomed out at around $43 late last year.
Yeah, a massive drawdown, almost 55% from its highs.
But since then, it's climbed back to where it is today, around $57. And we've seen some real buying interest coming back in.
And that's the signal, according to this analysis. The falling knife has stopped falling. It's been caught.
How so?
The stock has formed a classic technical pattern called a double bottom. For anyone listening who doesn't stare at charts all day, what that means psychologically is that the big money, the institutions, they stepped in twice around that $40 mark and said, nope, this is the floor. We're not letting it go lower than this.
So that conviction from big buyers creates that support. But okay, if the stock used to be at $93, why are we so sure that finding a floor at $43 means the fear is gone? Couldn't it just, tread water in the 50s for years?
That's a fair challenge.
Yeah.
And the confidence comes from what happened next, from the momentum.
Okay.
So since it established that floor, the stock has started making what they call higher lows and more recently, higher highs. It's a textbook trend reversal. The report even notes green days stacking up.
Which means more buyers than sellers on those days.
Yep. The momentum has clearly shifted from selling and panic into a recovery.
So the game now isn't just about surviving the fall, it's about getting positioned before the next leg up.
That's it. Buying at $57 is about trying to catch this new trend before it potentially breaks out past a really key resistance zone, which the report identifies as being between $60 and $63.
And if it breaks past $63,
that's the technical breakout everyone is watching. It completely flips the narrative from a stock that's recovering to a stock that's resuming its long-term uptrend.
yes.
And that kind of signal usually brings in a whole new wave of investors, which can accelerate things really, really fast.
Okay, so all of these factors, the valuation, the technicals, they seem to be converging on one single date, February 4, 2026. And that brings us to reason number 3, which feels like the most important timing element of all, the low bar earnings setup.
If we connect this to the bigger picture, this low bar is a direct result of that market psychology we were just talking about.
The bearishness.
Exactly. The sentiment going into this earnings report is super negative because of the supply issues and all the noise about competition.
Let's be specific about that noise. The competition is Eli Lilly, right? They have their own powerhouse GLP-1 drugs. So how does the report argue that NVO can deliver a surprise when everyone is expecting those competitive pressures to finally show up?
That is the whole point. The market has already priced NVO for the worst case scenario, meaning it's already assuming supply chain failures, loss of market share to Lilly, and nothing really exciting in the pipeline. So because expectations for February 4th are so low, the bar for success is just incredibly close to the ground.
This is the classic setup for a beat potential.
Yes. If NVO just meets these lowered expectations, the stock could move up just because the fear starts to fade.
But if they beat estimates, even by a little,
or if they offer a surprisingly positive outlook for 2026, the reaction could be, well, explosive.
And the report says the focus is shifting, right, away from the past problems and towards the future.
Crucially, yes, it's shifting away from the rearview mirror, those shortage struggles, and toward the 2026 roadmap. And that story is all about pipeline expansion, specifically oral Wegovy.
An oral pill, that's massive. Right now, these are all injections.
It's a total game changer. Switching to a pill just fundamentally expands the entire market. It improves patient compliance. It just makes everything easier.
So what's the timeline on that?
The report highlights that the commercialization for oral delivery methods should really start to scale in 2026. This is the ultimate growth catalyst. It's what justifies that old 30 or 40 times PE, not 15.
And to prove that management can actually pull this off, the report points to one more staggering number.
The return on equity.
NVO still has an astronomical ROE of around 78%.
78%. Just to put that in perspective for you, ROE measures how much profit a company generates from shareholder capital. A really, really well-run pharma company might hit 25%, maybe 30%.
So 78% is?
It's at a completely different league.
Yeah.
It speaks to an incredible level of financial discipline and efficiency.
That is just an elite number. It screams operational excellence. So even though the stock is down 40%, the actual business engine is performing at a championship level.
And that's the strongest argument against it being priced like a boring old utility. It connects all 3 pillars.
Right.
The price is low, that's the valuation. The panic selling is over, that's the technicals. And the underlying business is a hyper-efficient machine, which sets the stage for a positive earnings surprise on February 4th.
So what does this all mean? Let's zoom out and put it all together. What's the core thesis this analysis is presenting for you, the listener, looking at NVO today?
The synthesis is pretty clear, I think. You have this dramatic valuation reset with the PE pushed down to a level that just seems crazy for a company with this growth profile.
Right, down to 15.7.
Then you have the technicals, which suggest the stock has found a solid floor, ending that whole falling knife period.
And then the catalyst.
And the catalyst, the Q4 earnings on February 4th are just set up perfectly, with expectations on the floor just as the company is shifting the narrative toward the massive potential of oral Wegovy.
The analysis also gives some hard numbers, some price targets.
It does. The average analyst price target is $63.67, which is about 11% upside from here, just to meet the consensus.
But the real bulls.
The really bullish analysts, the ones who believe that historical premium has to return, they're calling for a move back to the high $90, with some even saying as high as $170.
Wow.
So the core thesis for you is really about seeing this temporary disconnect. If you believe in the long-term story of obesity care, and if you trust a management team that can deliver a 78% ROE,
Yeah.
then the analysis suggests that getting the stock at $57 before the earnings hype really starts to build is a very calculated move. It's basically buying the future at a deep and likely temporary discount.
And that brings us to the final provocative thought we want to leave you with. Think back to that incredible financial number that sustained long-term return on equity of nearly 78%. When a dominant, high-margin company shows that level of excellence, its PE multiple is really just an indicator of market perception, not of reality.
So the question to mull over is this: what event, other than just this one earnings report, could be the trigger that forces Wall Street to finally acknowledge that 78% ROE? What could cause that sudden violent push to get the PE multiple back towards its historical 30 or 40 times premium? Because that shift in perception, that's where the true long-term value is hiding.